Why has the S&P 500 dropped over 2%? Rising tensions between the U.S. and European nations, coupled with concerns over the Federal Reserve's independence, are sending ripples through the financial markets. Let's dive into what this means for investors. The S&P 500 index, a barometer for U.S. stock market performance, has taken a hit, sliding over 2% due to heightened concerns about the Federal Reserve's independence and growing geopolitical friction between the U.S. and EU. With the World Economic Forum in Davos on the horizon, market participants are on edge, anticipating crucial dialogues between European leaders and President Trump that could shape transatlantic trade relations. Meanwhile, political pressure from the White House on the Fed is adding to market instability. In this video, we'll break down the reasons behind the S&P 500's decline, including geopolitical tensions over Greenland and trade policies and the impact of potential changes in Federal Reserve leadership. We'll also delve into technical analysis of the S&P 500, highlighting key support and resistance levels to watch as the market navigates these turbulent waters. The S&P 500 has seen a notable decline of over 2%, primarily driven by escalating concerns about the Federal Reserve's autonomy and rising geopolitical tensions between the United States and European nations. Investors are closely watching the upcoming World Economic Forum in Davos, Switzerland, as critical discussions between U.S. President Donald Trump and European leaders are expected to have significant implications. These talks may shape the future of transatlantic relations during this period of heightened uncertainty. On the geopolitical front, President Trump's recent threat to impose tariffs on European nations opposing the proposed annexation of Greenland has escalated tensions. Countries involved, such as Denmark and Germany, have mobilized support for Greenland's autonomy. In reaction, the European Union is readying its anti-coercion instrument, which could restrict trade and investment with the U.S. This development is drastically affecting investor sentiment, causing fluctuations in the stock market as stakeholders anticipate potential economic repercussions. Simultaneously, concerns over the Federal Reserve's independence are mounting. Treasury Secretary Scott Bessent's comments that a new Federal Reserve chair might be announced soon have amplified market uncertainty. This executive pressure has heightened fears of potential political interference in monetary policies, injecting a layer of volatility into financial markets. President Trump's push for a more expansionary monetary policy contrasts with the Federal Open Market Committee's focus on combating inflation and maintaining employment, adding complexity to the current economic landscape. From a technical standpoint, despite these tensions, the S&P 500 index remains on a long-term upward trajectory, supported by its alignment with major moving averages. However, short-term indicators signal caution. The MACD highlights a gradual loss of momentum since late 2025, whereas the RSI points to growing bearish sentiment. Key resistance and support levels have emerged, with the index facing potential barriers at $6,977 and psychological thresholds at $7,000. Any breach may either propel the market into new highs or trigger more profound corrections below 6,350, underscoring the current vulnerability of market conditions. To summarize, the S&P 500's recent decline is driven by U.S.-EU geopolitical tensions and uncertainty over the Federal Reserve's future leadership. These factors are contributing to market volatility, with investors closely watching events in Davos and potential shifts in U.S. monetary policy. Understanding technical indicators like the MACD and RSI is crucial as they signal potential changes in market momentum. How will ongoing geopolitical tensions and changes in Federal Reserve leadership affect your investment strategy? Share your thoughts in the comments below. Don't forget to like and subscribe for more in-depth market analysis and updates on the latest economic developments.